Hello and welcome to AGN 3613. In this session we will look at some of the applications for the present worth and how can we be used to analyze different alternatives. Some of the major questions companies management need to answer or concerned about is it worth investing in certain alternative, and how long would it take to recover or break even with the investment or the project. Let's look at the following example. FedEx, for example, invested in adding 40,000 power pads to replace the paper clipboard that the carrier holds and get the signature of the customer when they deliver an item to the customer. The investment cost is $150 million. That will save the company 10 seconds per pickup stop with expected savings of $20 million per year. Now the questions are, is it worth investing $150 million to save $20 million per year, say over 10 years? How long does it take to recover the initial investment? What kind of interest rate should be used in evaluating business investment opportunities such as this one? Which means that we can we have to analyze the present worth for the money compared to the savings over 20 years. The analysis will identify the proper interest rate that can be accepted in this investment. For example, if the interest rate was more than 9%, then it will take us more than 10 years to recover, and that will not be acceptable. And that's just an example with any calculation. It's not 9% here, but I'm just giving you an example. If we brought the annuities of 20 million to the present value for FedEx, we will get their investment back within 10 years if the interest rate was around 5.6%. So bringing the 20 millions over 10 years, as we used to do with the graph, over 10 years, this is an annuity of 20 million. I will see that I can break even with the 150 million, get almost that amount if the interest is 5.6%. Now if the interest rate was less than that, they can break even faster and get profit on top of the 150 million. If it was higher than 5.6%, they need more than 10 years to break even with the $150 million that they invested at the beginning. To see how this works, you can use Microsoft Excel and find the break-even interest rate. You can actually even create a graph to show it. So the 5.6% interest rate did not include here the inflation rate, which is something that should be also considered on the long run, like 10 years in this situation. Let's take another example and perform a present worth analysis to judge the management decision. Mr. John Smith invested $800,000 in building a power generating plant that has a capacity of 6 million kilowatts. If the estimated annual power sales after tax is 120,000 with expected service life of 50 years. Was his investment wise? How long does he need to wait to recover the $800,000? Would he ever make a profit? All these questions need to be answered and can be answered once we do the analysis. This is the cash flow diagram that shows the money spent on building the plant or the hydro project. Again, we can bring all cash flows to a year zero, whether as future value or as present value, that can make both flows, inflows and outflows, equal. So these values can be brought to year zero as future value, and these values can be brought back to year zero as present value, and we make these two values equal to see if it is worth investment or not. So the money spent on the project will be brought to the future, while the money that was brought back from the project will be brought back to year zero as present value, using the formula P equal to A multiplied by the factor P given A with I interest and N number of years. In this case, we have N equal to 50. Since interest rate was not given, we can use the goal-seek function in Excel to find the value of the interest that will make the inflows and the outflows at point zero equivalent, or at year zero equivalent. And you can, like I said, you can try that, because I explained for you the goal-seek in Excel sheet before in another example. So you can use that to find the interest rate. When you take a loan from the bank, you would like to know the monthly payment amount and when will you finish repaying the loan. While when someone invests, or some company invests in a project, they would like to know when they can get their investment back and when they will start making a profit. In other words, that will be the return on investment. We call it return on investment for the amount of money that they invested or the project that they started. Let's look at another example. A company is considering purchasing a new system for a chemical process. The initial investment will cost $650,000. There will be $53,000 in annual maintenance cost from year 1 to year 8. When we say maintenance, that means it's out of pocket. So you have to understand, when you analyze or when you read the question, you need to understand which one is positive, which one is negative. While the company expects benefits of $215,500 per year. So those are the gained amount, or the benefited amount, or what we get as a revenue. In this case, we need to subtract the 53,000, the maintenance from that, and look at the interest rate, which is 15%, and N in this case is 8 years. The question is the project acceptable? Are we making money here? What is the net present worth for this project? To understand the cash flow in this example, we can either use a table as suggested in this slide or cash flow diagram. In the table over the 8 years, we can list the benefits which will be considered as inflows, money in the pocket, and the 215,000, then the outflows of the pocket, and that is the initial cost of the machine and the annual maintenance. So those are the two things that I need to consider. The net cash flow is listed in the last column, and based on that we can get the net present value. This is what we're getting as benefit or as gain. This is what we're spending. We spent at the beginning $650,000, then we started spending on maintenance $53,000 each year for 8 years. So what I need to do is to understand the cash flow, and since this one is out of pocket, then I will put it in negative. This is what I paid at the beginning. Now the gain is not $215,500 because I'm paying maintenance, and the difference will be $162,500. And this is the cash flow diagram, which is basically the same as the table. You can see that the inflows and the outflows shown here, and we can either do it with the first way where we have the 215 and the 53 and bring both of these back here, or we can subtract and say actually this is equal to 162,500 and bring that value to the present value. So this will be P2, this is P1, and I will find the net present worth or calculate the net present worth to see if this project is profitable or not. With 15% interest rate and 8 periods and equal to 8, we multiply the 162,500 by the present worth factor, which will result 729,189 and 74. If we subtract the result of this, which is this one, will equal to 729,189 and 74 cents minus 650,000, we will get 79,189 189 and 74 cents. Since the project over 8 years will end up providing a positive net present worth, then the decision will be to go ahead and accept this investment. If this was negative, that means I'm losing money. My target was 10 years, but I'm still losing money, then that will be rejected. And this is how we judge the investment, whether we go with the investment or not. So to answer the question of how can I recover my initial investment, we can use the cumulative cash flow or accounting profit, which is, if the payback period is less than what was specified, then the project will be considered for further analysis. Otherwise, it will not. The problem with that, if I just took the cash flow, the cumulative cash flow, without considering the interest, then that will not be a valid argument or really actual calculation for the net present worth. That's why we need to consider time value of money. If we are not considering time value of money, just the cash flow, as you can see here, we have we paid for example, for an equipment, $100,000, and we got back 20,000 the first year. Then I will subtract and I will get 85,000 in negative the first year. Then we gained 15,000 the second year, subtract, we get $70,000, and so on. All what I'm doing is calculating the cumulative cash flow from the money that we are getting, and I did not take into consideration any of the interest rate values or the inflation in these calculations. As you can see, over the years the negative value will decrease, and at a certain point we will get positive value in this period of time. This is what we call the payback period, which will occur somewhere between n equal to 3 and n equal to 4. If we actually create a diagram for that, a cash flow diagram, then with a cumulative diagram we can see how it payback at a year 3.2, and this is the payback period or point. You can go back to the FedEx example and the John Smith example and do just cumulative without using the interest, and see how would that work. Now the other, not the correct, actually the correct way to do it is to take interest into consideration, and in this case we call it discounted. So if the discounted payback period is less than or equal to some specified period, the project would be considered for further analysis, otherwise it will not. And the problem with this approach that any cash flows occurring after the discounted period are ignored. So if we calculated that for 8 years, the 9th year has been ignored. So we have to make sure that we are including all periods. This is an example of discounted payback period calculation, and in this example we are not just subtracting the 15,000 or the 85,000 minus 15 to know exactly how much we have still on the account, but we have to consider the 15% interest rate, which will give us actually $12,750 on top of the 85,000 as an interest. This is the interest for the 85,000. Since this is the interest, then I have to pay this first. So the 15,000 will pay 12,750, and what's left will go towards the principal value. And this is actually what happens with a mortgage, where any payment that you do actually goes towards interest, and very small amount goes towards the principal itself. And in this case we have only 2,250 that went towards the principal amount, which is the $85,000, and reduced it to $82,750. And this is what we owe now. And then with the 25,000, again we need 15% of what's left on the account. We add that, pay the 25,000, and we calculate what's left, and so on. That is taking the 15% into consideration, the interest rate or the time value of money into consideration. You can see the difference between taking an interest and just using the cumulative cash flow, and there is a big difference between this and that. And looking at the payback period, you can see that instead of being at between 3 and 4, now we are between 4 and 5, and it will take us more of like 4 years sum just to break even or to pay back the 85,000 amount. In summary, we can say that the payback periods can be used as a screening tool to look at liquidity or to measure investment or profit for a project or for an investment that was provided by the company or even a person. This is how we judge if we need to invest or not to invest, by looking at the amount of money that we are getting, the payback period, when can we get our money back, when we can break even, and when we can start making a profit. By doing this, or by our calculation, then we can judge, or we can take the decision on making an investment or not. That will be all for this session. If you have any questions, you can email it to me. Have a great day.